Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Happy Friday. Let's get to your top stories today. Stocks across the Asia Pacific gaining as bonds tumbling, with strong U.S. retail sales and jobs numbers bolstering hopes of a soft landing. Now, that economic resilience also prompting traders to shred bets on big rate cuts from the Fed. Now, we're watching earnings reaction to some of these big results out of Chinese tech. JD.com jumping in New York as profit beating expectations, but Alibaba revenue, they're missing estimates on weakness in its core e-commerce unit. Plus, China's central bank chief pledging further steps to support growth, but warning not to expect anything drastic.
All right, looks to be a happy Friday if you're into risk here. Now, take a look at when it comes to this risk rally. It looks like we are set to continue what we saw in the U.S. session after what we saw, whether it was the U.S. retail sales print, jobless claims, plus those Walmart earnings and the guidance from that company did seem to suggest that those recession fears in the U.S. are fading. So that certainly helped. You're seeing swaps pricing out, maybe less more aggressive cuts from the Fed here as well. I think it's less than 100 for the year right now. And you're starting to hear more from these Fed speakers that they're open to more rate cuts, right? We heard from Bostic as well, telling the FT that he's open to that September rate cut now. So here you go. APAC shares are up about 1%. In fact, we're set to snap out of 4 weeks of losses there. You take a look at what's driving that here. Taipei is up some 1% or close to 2% gains here. Watch how TSMC fares. But really, you're seeing the Nikkei, Kospi coming back from that holiday and really doing a catch-up trade. There you go. Taiwan Semi is up some 2%. And we're watching very closely what happened. So after that data that came out of the U.S., you basically saw stocks were bid up. Bonds were sold off. In fact, the two-year yield was up some 14 basis points or so. And the yen weakened quite substantially here. We're talking about 149 levels right now for that trade. And we're watching also what comes out with oil markets. We're still at $80. Iron ore recovering a bit here as well. Bitcoin also catching quite a bit here this morning. You take a look at how the Nasdaq Golden Dragon fared, and we did actually see some upside there, and maybe that will bode well for the tech space here today. But again, as Dave mentioned, that Alibaba miss was certainly one that is going to be weighing on HS Tech here today. CSI 300, though, it seemed like the data was enough yesterday, Dave, whether it was retail sales with that beat, that narrower decline in home sales prices did ease some concerns out there in the economy. So maybe that led to that rally that we saw yesterday as well. We talked about those ETFs and maybe more signs of the national team stepping in also. Yeah,
so the data, and I was about to say, maybe also some help from some of these state-backed funds, because we did see, and that's something we're tracking today, turnover in some of the CSI 300 tracker funds. We saw a pickup into the Thursday session, and certainly that went along with the price rally that we saw. So national team support, that is one of the items on our agenda today. Earnings reaction we talked about there, so you have this sort of seesaw effect between where we probably will see Alibaba, but JD.com, of course, also to the upside there, 4%. In terms of data, we're still waiting for the FDI numbers to come through out of the mainland. We are going to get some numbers coming through out of Hong Kong, GDP numbers, jobless numbers, the unemployment rate specifically. And at about the same time we do get those numbers in Hong Kong, we are also expecting the results of this quarterly review on the Hang Seng Index. Do we get additional representation from things like healthcare, for example? We'll talk about some of these predictions later on in the show, but back to, of course, the Fed conversation.
Yep, and we did hear from the St. Louis Fed President Alberto Musalem there saying that rate cuts are nearing as inflation does inch back towards that 2% target.
From my perspective, the risks to both sides of the mandate seem more balanced. Accordingly, the time may be nearing when an adjustment to moderately restrictive policy may be appropriate.
Let's bring in our executive editor for Asian markets, Paul Dobson. And Paul, it just seems like right now, the U.S. data is suggesting perhaps there is more of a consensus on a soft landing. And you're hearing more Fed speak seem more warmed up to that rate cut in September. What were the main takeaways, you think?
Yeah, that's right, Yvonne. I think the main takeaway is that the Fed can start to cut interest rates in September, and because it wants to, not because it has to, which I think is an important nuance to tease out a little bit. What do I mean exactly? What I'm trying to say is, the Fed believes that interest rates are currently restrictive, and it wants that in order to slow inflation. Now it's convinced, after this week's CPI and PPI numbers, that inflation is under control, is slowing, is coming down. It has that window to be able to cut interest rates. At the same time, a couple of weeks ago when we had that big flare-up in markets, people were starting to express some concerns that the US was, the economy, the growth was slowing too quickly, that the jobs data was starting to roll over, and that the Fed would have to cut more aggressively because of a slowdown. That doesn't seem to be the case based on what we've seen from the retail sales and jobless claims numbers overnight. Rather, the economy is still cooling, but not heading for any sort of disastrous recession or anything like that. It means the Fed can do gradual interest rate cuts starting in September, and the market really likes that. And I think what we saw in the rate pricing yesterday reflected that, where we had a rise in two-year yields. We're still priced for a cut in September, but the idea that the Fed is going to do the equivalent of 4 cuts, 100 basis points by the end of the year with only 3 meetings, is starting to look a little bit less likely.
Yeah, and Paul, what does that then mean for the path for global markets, which, it wasn't too long ago, eight days since early last week when we certainly had those gyrations in markets. Does this mean the path is clear for the bull market to resume?
It certainly feels like that little episode was something of a bad dream, right, David? Everybody is back onto the more positive path. We've seen gains in equities. We've recovered, more than 50% of the losses that we saw since the peaks in July. We're only 2% and a bit away from a record high on the global index again for stocks. And we're getting momentum. And what that can do is bring back in some of those momentum following funds, some of the commodity trading advisors or the volatility funds, which would have pulled back during the flare-up last week. So that will add cash. That will add flows and give the equity market more momentum, which can continue to push it higher. Won't be necessarily, a straight line up from here, but there's certainly a lot more positivity in the market as far as stocks are concerned. For bonds, we're going to have a little bit of a reset higher in yields, but we have just come off a pretty aggressive rally, and bonds are all still looking pretty positive now year to date. And people are still, if they see that the interest rate cuts are coming from the central banks, and remember we had New Zealand already this week, we had Philippines already this week, we've had a cut from the Bank of England earlier as well, so we're getting into that global cycle of lower interest rates. Then that can also give bonds some support through the rest of the year too.
Paul, thank you so much. Paul Dobson there in Singapore, our executive editor for Asian markets. Let's turn our attention now to China and tech and earnings. And certainly the reaction will be very much in focus as things open in about 22 minutes from now. Baba and JD.com reported results. Belle is here with us, our tech reporter, of course, to talk us through and break the numbers down for us. Let's start things off with, from the alphabet. Let's start with Alibaba.
Also the most important, I guess, as well. But Alibaba, we saw the real focus on its e-commerce division. And we know that's facing dual pressures, really. You've not only got the weak Chinese consumer, but you've got the very tough competitive landscape within China. And Alibaba really struggled in the face of both of those, because we saw the commerce division shrinking for the first time in a year. There was anemic growth of around 4%, but profit was down 27%. And the company as well really taking a hit to margins, because those shrank to around 15%. It was 18% a year earlier.
I mean, it seemed like when you look at the different business segments, there was a mixed trends that you're saying, whether it's the cloud, whether it's e-commerce as well.
Yeah, cloud was one of the brighter spots, really. That sort of had a pickup. We saw about 150% jump in profit. We saw growth of around 6%. I think the question that a lot of analysts have, and that includes our Bloomberg Intelligence team, is the sustainability. How long can they continue to see that sort of growth coming through? Alibaba has pushed through some very aggressive cost cuts for this division. In particular, they've slashed prices about maybe up to 55% on more than 100 different services. That's triggered a round of industry discounting that's come through. And actually, the Bloomberg Intelligence team is saying that Alibaba is going to start to lose that market share going into the next year to the likes of Huawei and other sort of more state-backed cloud providers.
JD.com, let's talk about that. I'm looking at the stock in the early goings. We are indicated substantially higher at this point. Could change, but probably a higher open for the stock there.
Yeah, and it would really track what we had in ADRs because we saw those gaining more than 4%. But certainly it does seem like JD.com is perhaps doing a better job of monetizing the different sales channels for its e-commerce platform. It also faces those same issues around competitive landscape, weak Chinese consumer, but they've had some pretty successful tactics perhaps so far. One of the latest that they've just rolled out to consumers is what's called the JD Super 18 sale. Super 18 because it means that on the 18th of each month, they're going to be basically offering products like Huicho Motai, Bulgari perfume for 18 yuan a unit. It's extremely cheap, of course, but they're just trying to lure in more buyers. They need to be able, though, to not only monetize that user traffic, but also to be able to benefit from those greater economies of scale. So something that analysts sort of flagged out of this. But yes, JD.com, better numbers, really.
Annabelle, thank you. Annabelle Jewelers there, a recap of the tech earnings that we've had overnight. Still ahead on the China show. We're going to talk to some big earnings and also talk about some big trends in China. We're going to talk to the EV technology with the CEO of ECARX and the challenges navigating U.S. restrictions on China's tech ambitions. And in the next hour, SF Reit's CEO will be with us to look at the performance of the logistics property sector in Hong Kong and the mainland.
But ahead of that, we'll turn our attention back to earnings and markets and specific bottom-up opportunities. And we'll be joined by analysis, of course, from Vivian Lynn Thurston out of William Blair, partner there and portfolio manager. Looking ahead to the opening bell, the Friday session, just 18 minutes away. Futures are pointing slightly to the upside. You're watching The China Show. Right, 15 minutes to the opening bell. Welcome back, by the way. Happy Friday. You're watching the China Show. Futures, as you can see, slightly mixed at this point in time. We're looking, of course, at earnings reaction from Alibaba, JD.com, and a few other big names are set to report earnings today. Let's get a sense of how the week has been in terms of earnings and, I guess, the outlook for the broader Chinese markets. Joining us now is Vivian Lynn Thurston, partner and PM at William Blair, joining us, of course, out of the United States. Vivian, good morning from the Asia Pacific. I know you run two strategies, one growth, and we'll talk about the other in a moment. But since you look at growth, too, I was wondering if you caught our previous segment. We just talked about some of the earnings, tech earnings this week. What's your initial assessment of what you've seen so far this week, as far as the guidance, too?
Absolutely. Yeah. Thank you so much for having me here today. And we still see more earnings to come out for the China tech companies. But so far, the big companies which have reported so far, I feel the results are pretty mixed. And to some extent, this kind of is expected, given that the macro and consumer backdrop in China remain very weak. And then precisely in the e-commerce space, the competition has also been pretty intense. So it's not surprising to see some of the biggest players in the e-commerce space struggling. And especially the incumbent player tend to see more challenges and losing market share. So that's kind of what I'm seeing so far.
Yeah, are there certain sectors that you're looking at that might be maybe a little bit more shielded away from the macro weakness in the economy? Yeah. What are some of the more resilient parts of the market that you're looking at?
Absolutely, yeah. So outside of the internet, actually, we like a lot of industries with a strong growth coming from overseas market and also still have very strong structural growth opportunities. So within consumer, for example, we do like cosmetics, beauty sector, and that's remain a very structural, attractive growth story. And in addition, we also like some high-end manufacturing industries, whether some semi-driven companies, they also benefit from the recent AI kind of catalyst. And we also like power equipment companies, given that China is on this very favorable phase to continue to upgrade the power grid and also continue to improve their domestically supplied power equipment products. So those are a few examples. And there's also another example is the home appliances. And that's also a pretty good story as of now, given the strong overseas growth. And outside of that, I think the EV supply chain, we still see some bright spots, even though overall the end market in terms of the EV OEMs remains pretty challenging given the competition, but there are still good players along the EV supply chain. Yeah, can do better.
Right. I want to ask you a follow on the EV supply chain because and I'm wondering whether you're concerned about this fierce price competition on the final product front. Are you starting to see that filter through in any way into the supply chain at all?
Yes, I think we have seen that impact towards more midstream and upstream kind of suppliers. So EV battery supplier is one good example. Even though it's much more consolidated industry, and also you have very strong leading players, both in terms of technology and also scale, but they are not immune from the end market side of the pricing impact.
I know you also been looking at some of these, these companies in China, SOEs in particular, that have really, done a lot of dividend plays or like buybacks and the like, which has been a consistent theme that we've heard from a lot of our China guests. I'm just wondering, how resilient do you think those dividend plays are going to be, or those dividends going to be, given that a lot of these SOEs we've been talking about are the telcos, the banks, and are quite cyclical industries?
Yeah. That's a very good topic, I would say. On the positive side, I do see some positive development among Chinese companies, including SOE companies, that they start to care more about total shareholders' returns. So if you think about dividend payment or share buyback, that are two typical ways for the Western companies to enhance total shareholders' returns, especially if they have a very strong cash balance or balance sheet. So that's a very good sign, I would say. Now more and more Chinese companies are doing that. So from the structural perspective, I think that's a positive support for the dividend plays, as you mentioned earlier. But at the end of the day, it's a total shareholders return, and that's what we are looking for as well. But on the not so positive side, I do feel the chase for dividend yield play in China also is a reflection of current deflationary environment of the economy. So when the economy is not growing, people start to look for yield, and in the fixed income side or now on the equity side. So this is a play before in many different cycles of different economies in the world, and more evidently is like in Japan back in after 1990s and in the 2000 era, 2 decades of no growth or even deflation. You see dividend yield play become very much center of the equity investment focus. So I do think as of now, a lot of those high dividend yield plays in China have been bet up quite a bit because of this chase. Yeah. So I think we tend to be more selective. Yeah. In addition to look for a high dividend yield, we also more focus on the fundamentals, the earnings outlook and all that.
Okay, Vivian, you also run the other strategy, which is EM. Correct me if I'm wrong, EMX China strategy. What are your current overweights in terms of the sectors and themes that you're looking at as far as the outlook for that strategy is concerned? And I'm curious because you also run China. Do you notice a difference in, are these two strategies almost completely uncorrelated at this point in time?
Yeah. For the EMX China, both our strategy and also as asset class, I think it has gained some traction in recent years, and both because of the geopolitical risk concern related to China, and also now because of pretty weak Chinese equity performance. So for us, we continue to like India in the EMX China side. So India has been a very strong story in the last few years. Post-COVID, they not only recover very strongly, also they are on this path to push forward more the Making India effort and also infrastructure growth than public capex spending. So under the Modi government, now he's going to start the third term, his vision in transforming India to a more kind of advanced infrastructure, more manufacturing-driven, more export-driven kind of economy is continuing to play. So we like this theme in India. And as a result, Indian consumption also benefit because it trickle down to employment and also income. And the other theme we like quite a bit in EMX China is AI-driven theme. And definitely a lot of Taiwanese companies or even Korean companies who are the leading suppliers in the global semiconductor industry, and then also benefit from the recent AI growth.
I was going to ask you about that. Did anything last week change your mind on these stocks at all, just given the whiplash that we're seeing on big tech overall?
Yeah, I would say from the fundamental side, it doesn't change our view because we still see on the fundamental level, those companies are very well positioned. And we are still probably in the early innings of this AI technology advancement. It's very common when you see such a disrupted industry or technology come through, it's never linear. So you will have these bumps in the road, and that's kind of where I'm standing. But from the stock perspective, yeah, we are very cognizant about the volatility. And part of it also because all those stocks have run up so much year to date. Therefore, certain consolidation is also expected. For us, we continue to focus on bottom up, the best positioned companies, which has the strong kind of a product offering, strong technologies, very niche dominant positioning. So those will continue to prevail. Yeah.
Vivian, it's great to have you. Have a great weekend. Vivian Lynn Thurston, their partner and PM at William Blair, joining us out of Chicago. Just take a look when it comes to some of these tech stocks in the pre-market in Hong Kong opening up, and you're starting to see that earnings reaction coming out from the likes of Baba, JD, and Li Ning. Interesting enough, Alibaba is up some 2%, despite that sort of wobbly trade that we saw in the ADRs. JD.com, obviously given that beat when it comes to earnings. Same with Li Ning. We're seeing gains of more than 6%. Plenty more ahead. This is Bloomberg.
Right, welcome back. Greater Chinese equity markets are poised for a weekly gain. Hong Kong is up on 2 straight weeks. Mainland China actually is managing to snap out of, I think it was 3 weeks of losses. CAC 300 yesterday, you had some decent data, and you had some signs that this pickup in turnover on some of these ETFs that might indicate some support from the national team. We're watching this closely, of course, as we move into the open today.
Yeah, it's interesting just how much. I think BI crunched some numbers. I think they spent about $66 billion this year. The national team, so-called, just according to what they've been tracking. But then again, we're still talking about the CSI 300 is still lower by 3% this month. So not really quite working. But then again, today we got earnings to deal with, and certainly this risk rally is playing out in Hong Kong too. Welcome back. You're watching the China Show. Our countdown opens in Hong Kong and, of course, in China today. And it looks like we are in Hong Kong, at least, joining in on this risk rally. We're basically on a 2-week run when it comes to gains on the Hang Seng and H-share market. CSI 300 also set to snap out of 4 weeks of losses, I believe. So certainly things are looking a little bit better. That data yesterday maybe suggests things are turning around slightly when it comes to the data.
Yeah, and also some indications from the PBOC that, and I think we'll get more clarity on that, this interview, of course, that Pan Gongsheng did with state media, and how he clarified both ways. Don't expect anything drastic as far as tightening or stimulus goes. So that takes us into the bond market rally, where I think we are entering week number 6, or we are about to clock in 6 weeks of gains on the Bloomberg China Treasury and Policy Bank Bond Index, in case you want to be pedantic about this. 10-year yield, as you can see, is now back below 2.2%. So we're looking at a mixed open across some of the big names. On the Chinese markets, flat open. Iron ore, though, seeing a bit of a rebound today following what's been several weeks of weakness. Copper is also seeing some gains today, 2% there, and some of your rebar futures also about 1% in the early goings. Right. In Hong Kong, the story is all about, you have data coming through today, GDP and jobless numbers. We have a revamp in the index, or let's see what the revamp looks like following the quarterly review. That should be out later today. And also about earnings. So Tencent up 1%, earnings out 2 days ago, reaction yesterday. Alibaba managing to shrug off the cobwebs really from the session overnight, so up 2.2%. Next on your screens is JD.com, and that's about to show you a decent gain. And also in Li Ning, on the back of this earnings beats, 6% give or take for both. MTR and Sands China are some of the names that are set to report earnings later today. today.
Yep, let's get to one of our top...
Sorry, MTR reported yesterday. I'm sorry, just to clarify that.
No worries. Let's get to one of our kind of top stories here today as well. The PBOC, the chief, has pledged further steps to support his nation's economic recovery while cautioning that it won't be adopting, quote, drastic measures. For more, let's get to our China correspondent, Min Lo. She joins us now. Was there anything new in this interview from the governor?
I would say it's rather cryptic comments from him because he didn't really clarify. He said, yes, there will be steps taken in accordance with the State Council, but he didn't really elaborate on what those steps would be. He did say, though, that there must be policy patience, that there shouldn't be any drastic tightening or drastic easing. But at this point, really, the economy doesn't need further tightening given the not very inspiring data yesterday. Yes, there was improvement in retail sales, but it was from a very low base in June, and then you had the unexpected decline in fixed asset investment as well. He reiterated that the PBOC is shifting away from these quantitative targets like the MLF, and yesterday we saw the PBOC delaying the announcement of the MLF rate to August 26. Our Bloomberg economics team believes that there will be one more rate cut in the fourth quarter, but increasingly after the data yesterday, more economists are expecting that maybe the PBOC could cut 20, maybe 30 basis points by the end of the year, especially because markets are now pricing in more cuts from the Fed. But of course, it depends on where the economy goes as well the rest of this year. Pan also talked about the need to promote price recovery. And that shows that, yes, the government is acknowledging this persistent deflationary pressure in the economy that is causing companies to pull back investment. We saw that very weak credit growth data recently. He also touched on the property sector, but again, didn't allude to any new measures. He simply reiterated the existing 300 billion yuan in relending facility and talked about how interest rates are already low, the down payment rates are already at record lows of 15%. But then again, that relending facility is seeing a take-up rate of only 4% so far, so banks are still very reluctant to be exposed to the property sector.
Min, thank you so much. Min Lo there, our China correspondent. Let's pivot now and have a look back at earnings. Tech, the auto sector, because the next company, of course, we're talking about here will be, certainly has a focus and that overlap between those three big things. We're talking about ECARX, a Chinese auto tech company backed by Geely. It's listed, of course, in the U.S., as you can see, up 11% overnight. It supplies software to car makers and also develops its own chips and technology with ambitions, of course, to take on big names in the sector, such as Qualcomm and also NVIDIA. Let's bring in the chairman and CEO of the company, Ziyu, Shen, joining us exclusively this morning from Shanghai. Good morning, Mr. Shen, and thank you for making time for us today. You know, we talk about your company and your tech, and the more I read up about the company, the more NVIDIA's name keeps coming up. And I'm wondering if you could clarify then for us, what of your technologies or your chips directly competes with NVIDIA at this point in time?
Okay, so that's very interesting topic. So I would like to clarify here. So we are not chip company. We are a system company.
Okay.
So we are providing computer technology system to OEM and the computing for digital cockpit system and the computing for ADAS system. That's what we are focusing on. Of course, in China, regarding the China national strategy, so we invested the company called SiEngine. So they are doing the IC design. So that's a very typical China strategy. So we are doing the similar SoC R&D with SiEngine team and build a computing baseline and foundation on our portfolio. So that's currently what we are doing. Of course, in global market, also we are very close partner with Qualcomm, and we are providing our Qualcomm technology platform as well for global OEM. So that's what we are doing right now.
Okay.
Yeah, you mentioned your partnership with Qualcomm. I'm just wondering, the U.S. is considering restricting Chinese-made EV software technology, which may actually impact some of the future expansion, I'm guessing, of ECARX with your U.S.-based customers. How are you likely going to overcome that?
Okay, good question. So actually, 5 years ago, we built our R&D team in Gothenburg in Sweden. And also we built a legal entity called ECARX Sweden AB. So 5 years ago, we started a software database over there from zero. And we very closely collaboration with Volvo Car. Also, we made the EX30, actually, which is the year of car last year, successfully launched 77 countries, including American market. So we fully compliance American requirement, American standard. to my point of view, we are going to be the international company. Even we started from China market, but we have to fulfill a global standard of each market, including compliance.
Right. And who would you then consider, given those ambitions to become overseas and to get more of your revenues from overseas, who would you consider currently your biggest competitor, local or international?
Okay, so I still think the global competitor is quite important for us, because in the auto industry, you have to be, the international player. Your customer has to be the global OEM. Otherwise, you cannot make your company bigger, right? So our main competitor still is from like APAC and LG, Denso, that's traditional global tier 1. They are still very big. Also, they are still a very big, profitable company. But of course, still like a big tech giant like Nvidia and Qualcomm, we need to partner with them. Of course, they want to do more things. So that's why we need a balancing, the tech giant and also traditional tier 1. So that's my view.
How are you looking at the industry overall? I mean, it seems like EV demand is slowing globally. Now you have big companies and big car makers like GM, Volkswagen that are walking back away from their electrification plans also. What is the future outlook going to look like?
Yeah, so in the future trend is very clear. I still very understand the market needs. So EV growth is slowing down, and most of global OEM is considering slow down their new energy strategy. I think that's fine, because we are providing computer technology. We are providing intelligent software to OEMs, not only EV, but also combustion engine, even PHEV. So we still can provide their core technology, because they have to make car to be the intelligent, right? So that's why we need to closely collaboration with global OEMs to provide a core technology to them and to support their global shipping. So that's our view.
Okay, I was hoping we could talk about financials. You guys reported a 30% jump in revenue. You guys reported last week, I think. This is for the second quarter. 1.3 billion renminbi. I want to ask you how you guys are tracking now for this current quarter. We're halfway through the third quarter. I think last year your revenues, I'm just looking at my screens here, for third quarter revenues of 2023, 1.08 billion. Are you on track to beat 1.08 billion in this current quarter?
Yeah, of course. I want to say we have very strong confidence on growth. To be honest, we already keep like 3 years 30% year-to-year growth. So also we have confidence in future, we still keep this kind of growth rate year-to-year. So that's why third quarter and even this quarter 4, we still very strong confidence on that, on growth.
Okay, so let's put a number to that. Full year revenue, do you think you get to 6 billion renminbi in 2024?
I think so.
Okay, fair. When do you start making money? Because I think you're still looking at losses.
Okay, so our revenue growth very, very healthy. Also, our gross margin is okay. And so, of course, we are losing money, but you can say, you already seen our balance sheet. Our burn rate is under control, very under control, and improved very much.
Okay.
So that's why we have confidence profitable very soon. So, and also because in the pipeline, automobile business, you need to take a very long time designing, and of course you need to have very long time, life cycle business. So that's why we already had a very strong and solid pipeline next 3 years. So that's why we strong confidence profitable very soon, and our growth still keep fast growth speed, and also with a good margin.
How do you look at the competition domestically in China? We've seen obviously a very violent sort of price war going on. Earnings from some of these car makers locally are getting squeezed, are getting hit, I should say. Do you feel it across the EV supply chain? Like, does ECARX feel it? Are you feeling squeezed and more pressured from these car makers here right now?
In domestic market, so very clear. Our strategy is around the good customer first. So everybody understand we started from Geely because of my co-founder Eric Lee, owner of Geely. But also we started a beyond Geely ecosystem in domestic market as well. So this year, for the first quarter, we announced a strong partnership with the FAW Group. So we are on full speed R&D with a very, very close their R&D team for their new generation EV and PHEV, all modelings. So FAW will provide us very significant contribution from finance and from strategic view next 2 and 3 years. Also, we will announce a couple potential partnership very soon, next 2 months, 3 months, because we already had a very strong, R&D achievements in China because we're super strong here. So we have confidence we can attract the good customer for beyond Geely ecosystem in domestic market.
Okay, well, since you mentioned, I need to ask you then, you said you're about to announce a new partnership these next 2 months. Can you give us a tease, give us a clue of what announcements are about to come? Who are the partners here?
You mean in domestic market or global?
Well, you mentioned that in the next 2 months you're about to announce new partnerships, and I'm wondering if you could tell us who they are.
Of course, cannot tell to you right now, but you will see very soon because that is the potential business opportunity, not only the partnership. Yes.
All right.
Very nice.
Leaving us guessing. So it was great to have you on. Thank you so much, Ziyu Shen there, Chairman and CEO of ECARX, joining us live out of Shanghai. And if you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. Join the conversation. You can send instant messages or even questions to our team and guests while those interviews are going on as well. Check it out at TV Go. This is Bloomberg. All right, welcome back to the China Show. Looking at a live shot of Hong Kong just a few minutes into the session here. And there you go. We're still punching higher by about 1.5%. We're up 250 points on the Hang Seng here, really propelled by some of these tech names here this morning. Even Alibaba, despite what we saw in the ADR as being pretty ending up flat after those mixed earnings, is actually catching a bid here this morning. And it's our favorite time of the year, Dave. The Hang Seng.
Why? Oh, this. Okay.
It's the quarterly review. They may add more stocks, particularly the healthcare, maybe tech, and logistics sectors in an upcoming review coming up. And then that's after including only one extra firm in May. Let's get to Sang-Mi Cha, our Asia equities reporter, joining us now. Yeah, what are some of the names being floated by analysts?
Yeah, so the gauge has about 82 constituents right now, and the whole purpose of the compiler is to expand it to 100 member, and they're doing it gradually. When we look back to February, actually they left the index unchanged, and so this previous quarter review, what they did, they added just one firm, BYD Electric. So a lot of the analysts are actually saying that this time around we might be seeing more of the new joiners coming in, and just like you said, healthcare could be the sector because they are the only sector that's underrepresented among the gauge. Some of the names are Beijing and Innovent. These are the companies that have the largest weightings in the industry group. We also have Cosco Shipping from the shipping company and ASMPT that does chip packaging. So various industry that we're seeing. We're seeing this at a time when Hang Seng Index has lost 4 years of losses, and it's fluctuating now, especially after the earnings season. There's a little bit of optimism going on here, so it will be interesting to see that after 5:30 today.
Yes. Okay. So 82 members. What else are we looking at today on your team?
Yeah, so the national team, so-called, came in and bought about $66 billion worth of ETFs this year alone, and that's not been enough to boost, the entire onshore stocks. We have been seeing that because of the economic doldrum that we've been seeing, but it's still a big number, and so they're trying to keep away from a huge decline, and that we have seen in losses in the onshore stocks, but that's in contrast with the HSCEI, which is a gauge that tracks the Chinese stocks listed in Hong Kong. So we can see that investor appetite there, the difference between onshore and the offshore market. Of course, the key stocks are the tech earnings today. So following the JD.com and Baba, we're going to be watching those, and also Galaxy Entertainment in the casino space.
Yeah, there we go. Set reports. Yeah, lots to watch out for today. Even though it's Friday, we still have almost a full trading day ahead. Sang-Mi Cha our Asia equities report. Staying in Hong Kong, so at about the same time we get the changes to the index, we'll be getting some data coming through, which we'll talk about. But yesterday, we did get some prelim numbers coming through from the tourism board in terms of the visitors coming through. So arrivals up over 50% in the first 7 months of this year, if you compare that to the same period last year. We welcomed 25 million tourists here in Hong Kong, with more than 19 million of them coming from mainland China. Now, for the month of July alone, Hong Kong saw nearly 4 million arrivals, marking a 10% increase from the same period of last year.
Yeah, and also we're expecting some numbers and data out of Hong Kong later on today. So we're talking about second quarter GDP numbers. We have unemployment data for July. We're likely to see, I think the print was for a 3.3% year on year.
Yeah.
But seasonally adjusted, we're talking quarter on quarter only a 0.4% print. And I think Bloomberg Economics has been talking about this, that, Hong Kong's growth and the outlook there, we're not even close to really reaching back to those pre-pandemic levels just yet.
No, not just yet. I mean, even just the context for the visitor arrivals numbers, while we are up over 50% from last year, we haven't quite gotten to the point where the arrivals numbers that we had pre-pandemic,
right?
Not to even mention the spending per GDP, right? Unemployment rate is also coming out today. 3% is what we are expecting there.
Yep, and you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter. Did you check out the one yesterday? You can sign up through the website, bloomberg.com/newsletters. Well, Indonesia is getting a new capital city, moving its administrative headquarters to Nusantara from Jakarta. The inauguration is scheduled for Saturday after President Joko Widodo's final State of the Nation address later today. Bloomberg's Avril Hong takes a look at the new city's progress.
Carved out of the jungles of Borneo, Indonesia's future capital, Nusantara. It's located around 1,200 kilometers from the current capital, Jakarta. An ambitious project spearheaded by Indonesian President Joko Widodo. It's funded by a mix of government and private spending. Construction for the massive project began in 2022 at an estimated cost of $35 billion, with reports of massive cost overruns. The aim? To build a futuristic green city in place of overcrowded Jakarta, a capital that's rapidly sinking into the sea. About 40% of Jakarta sits below sea level, and its coastal areas are under constant threat of flooding. This causes about $6 million of losses each year. Productivity losses from traffic gridlock are estimated at $7 billion a year. Though it's being inaugurated this month, Nusantara is not scheduled for completion until 2045. Satellite images in the past few years show the development of the area. But on the ground, missed deadlines and sudden resignations of top officials plague the project. During a recent trip to Nusantara, Jokowi stressed that building a new capital is not a job that takes 1 or 2 years.
We came here to check the latest progress of the Ibu Kota Nusantara, especially the construction of the palace. I see everything is still in process.
President-elect Prabowo Subianto has pledged to continue development of the city. Yet his manifesto makes clear he'll focus on his own policies, casting some doubt on Jokowi's legacy project, even as he prepares for his final State of the Nation. Avril Hong, Bloomberg News, Singapore.
Yeah, and part of that speech as well is going to be, Joko Widodo laying out the budget plans for 2025. And it's interesting, we have a trader's guide out there talking about what parts of the market might actually benefit. So as they're looking at things like mineral refining, health, consumer stocks. I mean, obviously the material space, given this move to Nusantara. And Indonesia, for the most part, if you take a look at the last 10 years or so, has really outperformed much of the region in Southeast Asia. And really, we've seen about, a 45% climb since Jokowi became president.
It's been consistent. It's certainly been one of, if not the structural pick from strategists when we ask about Southeast Asia. This is the one market that they keep talking about on the back of things that Yvonne was mentioning too, things like minerals, for example, the downstreaming of certain of these things. So certainly something to watch. Of course, speaking of Southeast Asia, very briefly, one market that opened up this hour is the Philippines post the rate cut yesterday, and another one is being flagged by the central bank governor for the year. The market is up the most in about 5 weeks. The currency is reacting to that, poised for the biggest drop in about 2 months.
Yeah, and you're starting to hear more from these central bankers more comfortable with these cuts, right? We heard that from some of these Fed speakers overnight. Yeah. But even with the governor of the BSP, it says, there is more reason for this easing. They are less concerned about inflation, and they say there's more confidence in the inflation numbers coming down than the GDP numbers going up right now. So growth certainly is a key concern now, too.
Yep, cuts are coming. A lot of earnings to tell you about, Sue, so we have an hour left. Of course, on the China show, plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session. And right now we're taking a look at overall Asia is doing quite well here today. Asia Pacific is up 1.7%. And we're set to really snap out of a 4 weeks of a skid. So certainly that helps with sentiment. Obviously, what we saw from the U.S. data overnight, some Walmart earnings that really helping to suggest that maybe the U.S. is not seeing a recession anytime soon here. And there you go. The CSI 300 also having a good week as well, Dave.
Yeah, and that takes us into, I think to your point, right? We're doing very well because of, I think, two other markets to tell you about. The Philippines is post-rate cut.
Yeah.
And, the confidence that central bankers are getting to even guide for future rate cuts. And then in Japan, I mean, just to show you how volatile this market is, the market is up 3%. And this is the best day in, I think, 2 days. So we've seen a similar move very, very recently on this market itself. 1.7% to the upside. S&P futures, as you can see, we're set to snap a 4-week skid. Also something that's taken place this recently, I would say in the last 2 weeks or so, is this breakout in treasuries to our point on this pivot towards a more dovish stance of central banks. We'll talk about that later. We're also watching the weather in Japan. Heavy rainstorm warning over in Tokyo. We'll get you an update. We understand that hundreds of domestic flights have already been canceled. We'll get you an update on that. Chip stocks, to the point we were making earlier, that that misbehaving market that we had 2 Mondays ago is maybe just a nightmare we can all forget. As you can see, chip stocks are bid up substantially. And the rally in treasuries, very quickly, have a look at where we are. So the Bloomberg Treasury Index total return, for the first time since inflation became the rat poison of bond markets over 2 years ago, is now finally trading back above the 200-week moving average, and momentum is certainly on the side of the bulls as we speak.
Yeah, and we mentioned about Musalim. This is the St. Louis Fed president talking about, the Fed cuts are coming, or at least nearing there. You had Bostic this week say, look, I can back maybe a September cut now as well. So the Fed speak is getting a little bit more dovish as well, and really kind of coinciding with what the market is pricing in. Let's bring in Mark Cranfield, our MLI strategist, joining us now from Singapore. Mark, and traders have been whipped around with this U.S. data. I think we have one more jobs report before that September meeting, and then we have Jackson Hole next week. I mean, is there more sort of whipsaw to come?
Oh, plenty. And we're getting used to these daily moves around major events. And it's not just those that you mentioned. We've still got a PCE report to get through. We've got, as you say, one more jobs, one more CPI. Jerome Powell setting up the outlook from Jackson Hole. And that's in addition to anything that may come out of left field or from European or Japanese data that may confuse the picture as well. So traders are getting used to bigger swings on specific days around US data. We had another one last night with the jobless claims and the retail sales. So that's the way it's going to be. And it's not too surprising when you consider how much is priced into the US curve. When people are looking for rate cuts basically all the way through to the end of next year, that's an awful lot of weight is being put into where markets are going. And so you're bound to get volatility as people pare back their positions around that. But if overall, if you look at the pricing in terms of derivatives markets, traders are still very convinced that the Federal Reserve, not only is it going to cut rates in September, but it will be following up with several more after that.
Well, Jackson Hole is coming up next week, and Chair Powell better signal that rate cuts are coming in September. Otherwise, we'll get another market meltdown. Paul Dobson, our colleague, made a very good point in the last hour that now markets seem to be, the reason markets are doing well is because it seems the Fed will cut because they can cut and not simply because they need to cut. How much are expectations weighed now on Jackson Hole next week?
Mr. Dobson's a very smart chap. Yes, he certainly, Jerome Powell is in a position where he himself appears to have been fairly dovish, probably one of the most dovish within the FOMC this year. If you think back to the first quarter of the year, had there been a window, Jerome Powell would have probably on his own cut interest rates in the first quarter of the year. But he couldn't persuade the rest of the FOMC that it was the right thing to do. And of course, then the CPI data went higher, and it was probably just as well that they didn't move. But certainly, he doesn't need any more convincing. That's the way that investors are reading it. He will probably tread fairly carefully in what he says at Jackson Hole. He will want to set the conditions that, yes, traders have got it right. We are going to cut in September, but we're only going to do the 25 basis points. It's not going to be any bigger than that. But he will probably try to avoid giving too much guidance on where they're going from there. May appear to be not as dovish as what some of the pricing in the market appears to be. But all along, there's been this fight between where traders see the data and where the Fed speakers see the data. And you can see there's still a little bit of disagreement among Fed speakers. They're not united in all saying that rates need to come down dramatically. Yes, a little rate cut. Maybe we go on a pause after that. So he'll want to leave things in balance. But the traders will be looking very, very closely at the data, especially the next jobs report. It was a real shock to everybody that the unemployment rate jumped to 4.3%. If it doesn't come down, then traders will feel they are absolutely right to be pricing for multiple rate cuts, even this year. Even though the dot plots say only one, traders are convinced there's going to be at least three. And the jobs report will be the one that really decides for them whether they're on the right path or not.
Mark, thank you so much. Mark Hanfield there in Singapore for us. Turning from macro now, let's look at micro and earnings. So Alibaba, JD.com, positive reaction to both, though there's a difference between the texture of the results here. Baba's up 3%, JD.com tracking the move overnight, up 7%. Catherine Lim here with us on set, our senior analyst for Bloomberg Intelligence. I understand you were up late, listening to the earnings call. Let us in. What did they talk about? Start with Alibaba.
Well, there was a lot going on 24 hours. Got China retail sales, Baba, JD.com, leadings reporting as we speak right now. But you know what? Really coming out of Alibaba's results, I know the focus is on China slowdown, but what's new, right? There are positives in these results. I mean, look at their cloud business, great growth and profitability, and they are very confident about getting to that double-digit top-line growth in the second half of their fiscal year. And notwithstanding, look at their local services losses narrowing. And of course, it is actually a good sign that they are focusing on efficiency. We've got Meituan coming up with results in about 2 weeks' time. So let's hear from that on. So I think, Alibaba, there wasn't really anything, fundamentally getting worse for the company, which is the good thing.
Yeah.
And we have to actually just see how they deliver over the next few quarters.
Can you tell us a bit more about cloud? It seems like there was growth picking up there given the strong demand for AI too.
Yes. Well, they've spent a lot of time talking about the Olympics itself. And really, I think what stood out really was that, there's actually very strong demand for their AI products and services. And the company is now seeing an overwhelming demand, and they're trying to actually come up with more solutions. So, a good problem to have if you ask me, and hopefully that translates into the numbers for them.
JD.com specifically, because I know there's an overlap there with Alibaba because they share one of their businesses. Any specifics on JD.com?
So obviously JD.com is more focused on China without that overseas angle itself. They've done well. The growth has also slowed down for the retail side to just a 1%. for their 1P, 3B businesses. But, going into the second half of the year, I think at this rate, they do continue to actually see the need to actually push out some of the lower priced products itself, because consumers are getting, more budget conscious. So we got to actually see how that comes in, particularly, in the lights of PDD, etc., as they continue to actually try to retain their market share.
Li Ning reported about, I think, if I'm not mistaken, just about 2 hours back. I'm looking at my terminal. You guys have already put out, how quick are you?
I know.
A reaction to this. Yeah, so what's your takeaway for
Right.
Shares are up 6%, I think.
So management,
4%,
management is, giving their spill right now. But it was a great set of numbers in the sense that, they are, it was very strong margins that they've delivered. They've actually hiked dividend payout and actually giving you more as dividends, even as earnings comes true. So I think that really allays the fears that, things will deteriorate for them in second half, even if sales doesn't, match up. But earnings-wise, the company is comfortable to actually keep it as it is and continue to actually reap operating efficiency. So all good.
I don't know how you're still so energetic after the night that you had, but thank you for bringing that energy.
In a good way.
In a great way.
In a good way.
Maybe it's just pure adrenaline at this point.
Possibly.
Catherine Lim, thank you so much. So glad to have you here in Hong Kong this week. Our Bloomberg Intelligence analyst, Catherine Lim there. Let's talk about what we've been seeing in these Chinese markets, right? So China's efforts to prop up its stock market seems to be doing little to bleed the stemming. We got someone who wanted to show us this chart.
Yeah, don't clean out the volumes, though. That's important. There we go.
All right, equities still remain under pressure even after a $66 billion buying spree from the so-called national team. Let's get in our Bloomberg Intelligence ETF analyst, Rebecca Sin, to join us more on this. So has this sort of state buying spree had any effect?
So in some ways, yes, but on others, from an investor sentiment, no. So we expect that the national team can purchase as much as $100 billion worth of ETFs this year. And to your point, they've bought $66 billion year to date. So this is an enormous amount. To put this into perspective, for all of the flows in mainland China for 2023, it was roughly at $70 billion. So the national team has purchased the equivalent to all of the flows in mainland China for 2023. But what we found is that it hasn't really boosted the investor sentiment. It's kept the market from dropping, but it hasn't really boosted investors' sentiment. And so what we've seen is actually the contrary. In February and May, I think we saw some outflows. And so overall, the national team is accounting for a large portion of the China market. And we expect that by year end, they could hold as much as 25 to 30% of the entire ETF market of mainland China.
It sounds like the BOJ, but that's a different topic. That's a different. What patterns have we seen in history here as far as the Chinese story is concerned?
So the Chinese has really come in when the purchase really occurs two times. One, when there's any large political backing. So, for instance, last month when the plenum occurred, the National Congress meeting when they meet, or when the market drops. So we found that, for instance, when the CSI 300 goes below 3,300, they'll intervene and support the market. And so they're really replicating what Bank of Japan did, because Bank of Japan did very similar things with the Nikkei and topics. When it dropped below a certain point in the afternoon, they would come in and purchase. And so in terms of pattern, we've seen similar to what the Bank of Japan has done. But I think the difference is that Bank of Japan holds roughly 75 to 80% of the ETF market in Japan, and the national team of China only holds roughly 25 to 30%. And so they're starting from a much lower base, but the difference is the national team is purchasing at a much quicker rate. And so they really only started purchasing ETF last year. They did a little bit in 2015 and then sold it. But the thing is, the Bank of Japan started buying ETFs in 2010. So it took them 14 years to amass this 80% of the market. And now we could see the national team buying as much as 25, 30% all in 1 year. So it's very, very, very fast speed.
Rebecca, great stuff.
Fantastic.
Rebecca Sin there from Bloomberg Intelligence, our ETF analyst. And coming up, we're going to hear why SF Reit is seeing geopolitical risk clouding its business outlook. We have the CEO, Hubert Chak, joining us next. This is Bloomberg.
Right, welcome back. You're watching the China Show. SF REITs, as you can see on your screens here, 1.5% to the upside. Coming off, I think it was also a very good day yesterday on the stocks. So the company out with some earnings coming through. logistics focus, of course. If the name is familiar to you, real estate investment trust here listed in the city did post results. Joining us, of course, to talk us through, of course, these results today is Hubert Chak, of course, with the company as well, CEO. Good morning and nice to see you. And take us through how was the last 6 months?
Thank you.
For the business.
In one simple word, has been tough. Market has been tough. But I think as a real estate investment trust, I think we look for stability. So I think I'm happy to report that, we have been delivering consistent growth in the last 3 years since our listing in terms of revenue, income, and distribution.
What do you think contributed the most to these results? You mentioned a little bit more about, where interest rates are, also geopolitical risks. I mean, what do you think remains to be the big risks for the company now?
In terms of risks, I think in terms of rental first, the property market rental will continue to be under pressure in the short term. Luckily, 80% of our income is from Hong Kong. Hong Kong has been stable, but I think it will become more challenging in a couple of years as the economy slows down. Okay. In mainland China, it has been under downward pressure the last few years, and I think, again, in the short term, rental will continue to be under pressure. So in this market, what management would need to do to besides save costs in terms of operation costs, but more importantly, interest expense.
Okay. Now, you mentioned it's been difficult, the operating conditions. Do you expect those conditions to persist? Do you have any visibility on when some of the headwinds, whether that's internal or external, start to dissipate?
We're lucky in that 75% of our income is from our group companies, and they have been quite stable.
Okay.
Of course, but the other 25% we will continue to be under pressure in the short term. And I think the key for management now is to look for windows. One big uncertainties we face now is the interest rate cycle. It's very likely that it's going to turn. How quickly it's going to turn, no one knows. So what management is actively doing is try to look for windows to manage our financing costs, not just in the coming 6 months, but more important in the next 12 to 24 months.
What are you doing in terms of rents right now? I mean, obviously, earlier part of the year in China in particular, we were flagging vacancies in some of these logistics storage areas. How is it looking like now? I mean, have you had to adjust your rents in any way?
If you look at the mainland China market, overall, I think occupancy is not good, particularly in the north, where occupancy is only in the 70s. Even the strongest, Huadong, Eastern China, it's only in the 80s. Whereas in southern China, in particular in Greater Bay Area, occupancy has been in the high 90s. So we're fortunate that we have properties in these regions. But rental has been under pressure, as you can see. It also affected our valuation as well, because when rental goes down, valuation would correspondingly be adjusted.
Is that the reason why your net income is a lot smaller this year than it was this time last year?
Correct.
Is that the valuation impact?
Yeah, because the valuation gain loss goes to P&L. Right. But that's non-cash. It doesn't affect our distribution.
Yeah.
Okay.
How is what we're seeing, this consumer malaise in the e-commerce sector? Has that been something that's been weighing on your business as well?
Good and bad. Good in the sense that in terms of volume, number of parcels being handled in mainland China, also in Hong Kong, has been on the uptick. It's still growing at double-digit level. So our group's business has been busy. So, but the challenging thing for overall is that the value of each parcel is continuing to drop. So the e-commerce platform, we try to compress the costs, including logistic costs.
Right.
So our tenants' margin is also under pressure.
Yeah, I was about to ask how that affects you guys. That's the transmission effect to you guys? This inflation story we're seeing in China.
Yeah, I think overall economy is still challenging. In the whole of China, rental is under pressure. So what we need to do as a landlord is that we need to understand our tenants' issues. What difficulties are they facing? Are they going to adjust? How are they going to adjust and try to accommodate their needs?
Now, in terms of your footprint, so you've run effectively 4 groups of assets. 1 in Hong Kong, 3 in the mainland. Is it time to be looking at adding to that, or is the environment too soft to be aggressively looking at? Because there are distressed assets out there in the market right now. And I'm wondering from your perspective how you're looking at that.
From an investment point of view, M&A, I think we continue to actively look at suitable targets, in particular the assets owned by our group. Okay. But in terms of the overall capital market situation, financing cost is still high in Hong Kong. Structurally, we have to borrow in Hong Kong dollars, although part of our borrowing can be in RMB. But Hong Kong dollar borrowing costs continue to be high. So it will be quite risky now to move on any acquisitions because market might change, very quickly, and our distribution may suffer. The key is we want to manage our business such that it continue to deliver, a stable distribution to our investors.
And I'm curious, you mentioned, rates are extremely high still. Hopefully the Fed cuts next month, and hopefully the cut is deeper than most people think. Why don't you finance onshore? I'm just curious, why don't you finance onshore where rates are extremely low?
We have been doing that. Our first acquisition since our listing, we finance basically 50-50, 50% in Hong Kong dollars, 50% in RMB. Right. So we will continue to do that. The point is, Hong Kong dollar rates are still high, and the capital markets is not favorable. I think in the short term, for 2024, it is unlikely that we'll do any acquisitions. But we are actively monitoring the market, getting ourselves ready. Right. So as soon as the market turns, we will be much more active on the acquisition side.
Yeah, you mentioned gearing up for those opportunities. What may they be? I mean, is there something that's on your radar right now, and you're just waiting for the dust to settle?
Our focus will primarily from the group, the assets owned and developed by the SF Group. Okay. In particular, in the Greater Bay Area, because we see that in the short term that region will perform well. Partly because overall, in terms of overall supply, is not as high as the other regions in China. Secondly, because of the cross-border e-commerce platform emerging in the region, demand for logistics service and logistic properties is still quite high.
Right. The outlook beyond 3 years, do you have any visibility beyond the next 6 months? How do you plan your business around something that is, I would imagine, highly cyclically exposed?
Okay, in terms of managing our existing portfolio, stability is very important. Right. So we look for ways to smooth out our rental income going forward. We're not in a high growth business. Collecting rent is not going to have explosive growth. Right. So it's very important to manage the stability of the income. Financing costs is very important as well. So we need to make sure that we continue to monitor market, and when appropriate, we use tools to reduce the risk on the financing costs.
Hubert, it's great to have you. Hubert Chak there, CEO of SFRIT, or Reit, I should say, joining us here in our Hong Kong studios. We got plenty more ahead. This is Bloomberg.
Here are some of the stories we're tracking at this point in time. So Bloomberg has learned that Seagram heir Edgar Bronfman Jr. is, close to making an offer for Paramount Global, setting off, of course, this potential bidding war for the entertainment company, rather. Now, sources say Bronfman is weighing an offer for National Amusements, a company, of course, controlling Paramount, as well as Paramount itself. Paramount's agreed to merge with Skydance, just keep in mind, of course, back in July. Now, Walmart shares jumped after the company boosted sales guidance for the full year and reported adjusted earnings that actually also beat analyst estimates. The retailer's outlook is getting a lift from consumers buying necessities like groceries and seeking deals even as they cut spending elsewhere. Walmart also raised its targets for operating income and profit. Speaking of earnings and profits, earnings reaction coming through quite favorably for the likes of JD.com and JD Logistics, reporting, of course, after the Hong Kong close on Thursday. You already saw a big pop in ADRs overnight, and you are seeing that play out in the Friday session. Chung Kong Holdings also reported yesterday, and we're seeing that pair back on the back also of that reaction. And also Lenovo also reported earnings, which I should emphasize Lenovo has done extremely well, of course, as a stock so far. Due to some profit taking off the table. Right, flip the boards, please, if we can. Have a look at what else we're tracking here. And, some of these anti-money related stocks here after this export control ban. Of course, these are super hard, super durable material stocks playing through quite substantially going into the first hour of the session. Speaking of, we'll leave you with some live pictures out of Tokyo. A weather report is just ahead. Right, welcome back. It's 11:29 in the morning in Tokyo. We need to be that specific given, of course, the weather system that is disrupting flights and trains. Severe typhoon, of course. In Japan, we understand 90 flights between ANA and JAL have been canceled. This is to international destinations. Bullet train services have also stopped between places like Tokyo and Nagoya. In case you're looking at a trip to Disneyland today, the parks are actually closing early at 3 p.m. So in terms of planning, if you want to make that trip into Splash Mountain, make it early before you walk out into the real thing.
And get more splashed even more.
Yeah. But yeah, watch that closely.
Yeah, we're taking a look at that very closely as well. But yes, this Japanese market continues to seem pretty stable now after, maybe close to 2 weeks of wild swings. But right now we're seeing a lot more stability across the region in general, right? We talk about how Asian stocks are doing. We're close to 2% gains on the MXAP. U.S. futures are punching higher as well. Dollar is a little bit flat. But really all sectors are in the green with the exception of real estate here today. Let's bring in Tim Mo, Chief Asia Pacific Equity Strategist at Goldman Sachs. He joins us live from Singapore this morning. Tim, there's been a lot going on the last 2 weeks or so. I'm just wondering how you're wrapping your head around this now. I mean, things have stabilized a bit. Are we thinking back now? Were the growth concerns a little bit overdone, and was this just summer seasonality?
Yeah. So a little bit of all that, Yvonne. So and hi, David. So I'd say a couple of things. I mean, clearly, just to super quickly summarize recent history, we had unwind carry trade, and obviously the concerns about weak non-farm payroll in the United States, which led to market pricing in a greater degree of recession concerns. And some of that's been priced out given the news flow that has happened, which in fact is our view. So we're looking for a 25 basis point cut in September by the Fed. Market is kind of now moving towards that, having been pricing 50. And our view certainly is one that's still more constructive in consensus on growth in the U.S. And that really is a pivotal issue fundamentally for Asia, because if you look at how markets have performed historically during Fed cutting cycles, and there have been 8 since 1989, 4 of them have been ones where there has been a recession, and 4 of them have been ones where there has not. And the market reaction is very, very clear that when you have a Fed cut and you do not have a recession, then markets tend to do quite well after that in the subsequent 3 and 6 months. Whereas if you do have a recession, then markets obviously do poorly. So the point is of this that growth really matters. So if our view is correct that we will start to have a Fed cutting cycle and we will not have a recession, then that should be constructive for markets, especially because underlying earnings are coming through and valuations are still reasonable. So that's sort of our core longer term view. The nearer term, which is really the weaker seasonal months of August, September, October, combined with the run up to the U.S. election, suggests that things may be still bumpy, in the next few months. But our core view is still a fundamentally constructive one for the reasons I just mentioned.
And Tim, some of the big winners, Japan, Korea, and Taiwan took the brunt of the selling last week, and I think we're still down over 10% on the 3 there. How do you look at those 3 big winners that where we saw markets take some of the profits in terms of just the outlook ahead? If nothing really has changed, do markets still stick with the winners, or are you starting to look elsewhere?
Well, it's a great question. The punchline is that we stick with the winners. We have seen some broadening out. We saw ASEAN perform better in relative terms. Indonesia's come back 10% from its low. It sort of sold off too much. We're overweight there, by the way, and we felt that it overtraded macro fundamentals to the downside, and has since recovered, both in local currency terms as well as the Indonesian rupiah rallying. But clearly, where the earnings growth is coming through is still in those key North Asian markets, David, that you mentioned. At exactly the same time, we were writing about the sharp sell down a week ago. We actually raised our numbers for MSCI Asia Pacific ex Japan broadly for the full year from 17% to 19. And that's a function of better second quarter results, about half the second quarter in the bag now. And the numbers are coming in somewhat stronger than expected. Beats versus misses, 4% median positive surprise. We've seen about a 2% increase in consensus forecasts since the start of the third quarter. And C, we've seen the upgrades really concentrated in Korea, which is having a very strong cyclical recovery, particularly in the semiconductor sector, Taiwan, and also some good lifts in Japan. So it's those three markets you mentioned, David, where we're seeing the earnings fundamental strength coming through. And we think with the overreaction to the downside, which really took a lot of the sort of the positioning excess and maybe some of the valuation improvement that had built up, particularly in Japan, it pretty much wiped all that out and left us again with a very favorable fundamental valuation versus earnings growth configuration, which we think one should lean into.
Okay, does that keep China sort of in the pecking order in the lower part of the totem pole, Tim? Because you mentioned, when there was that overreaction in some of these winners, and in terms of the overreaction declines, China actually was in some ways outperforming relative to, of course, Japan, Taiwan, the like. Is there actually good benefits of being different?
Well, great question. We actually just wrote a piece on that, slightly almost entitled that way. So you're right that China, in fundamental terms or just empirically, is basically flat for the year. So it's not been terrible, but obviously it's lagging behind what other markets have done, even with those markets having corrected. But I think the fact that China had not done well, that positioning is light, that valuations are very low and so forth, has given it, at least in portfolio terms, some diversification benefits. So literally, we just wrote about this in a report that my colleague Kinju Lau lead authored 2 days ago. And we pointed this very fact out, that you've got sort of this diversification benefit coming in from China. That being said, investors are also focused on how do you make absolute return. And the challenge in China is that domestic demand is still very weak. We actually cut our numbers for the A-share index, the CSI 300, a little bit down to 6% earnings growth this year, which is still fairly significantly below consensus. We're at 8% for offshore, the MSCI China index. So we have a favorable fundamental circumstance, but we need to see earnings growth recovering, and that in turn needs more policy support. So I think really the market's eyes really are on whether policymakers will lean in to a greater extent in terms of fostering domestic demand.
Tim, what if they don't? What if they don't come through with, and the central bank governor, I'm not sure if you saw he did an interview with state media and talked about
Shen
not to expect anything anything drastic from the central bank. So if indeed we are not going to see massive stimulus, fiscal nor monetary, does that even change the calculus? Because these valuations, to your point, are already quite cheap.
Yeah, so the valuations are cheap, well, okay, so direct answer to your question is I think it really points to the alpha opportunities in the market, but the debate may still be subdued. I think in order to get the market going more firmly and sort of collectively up, I think there does need to be greater sense of policy support, particularly on the domestic demand side, which is what's flagging. So the story in China, of course, is that we're tracking roughly in line with 5% GDP growth. And I think there's some downside risk to that given the weak start to the third quarter. But it's really an imbalanced tale where exports are doing well, the external part of the economy is doing well, and the domestic part is obviously not. That in turn leads to an imbalance in terms of earnings. So we're seeing a lot of the platform internet companies, for example, which we're positive on, doing well, and their share price is outperforming, whereas a number of the domestic demand side, which is sensitive to lower consumer spending and a tendency for consumers to trade down and margins coming into pressure for a number of companies in that area doing less well. So I think we still think there's a lot of alpha opportunity in China, but punchline is that in order to get the aggregate market getting a lot more upward momentum, I think we do need to see some firmer sense of support from policymakers.
You mentioned there in that report, strategically positive on A shares, but still think the offshore market could tactically outperform in the next 3 months. Can you just walk us through the thinking behind that call?
Sure. So, and I'll be concise here. So we have a long-standing series of arguments for why we think A shares are doing better. We think that policy is clearly behind that structurally, and that was exemplified in the 9 measures which came out in late April. We did a report, actually went up and saw the CSRC about that. So there's a very clear strategic intent to improve the development of the A-share market for a number of very clear strategically positive reasons, including a need to foster, for example, domestic technology, formulation for which you need an ecosystem for PE and VC. To do that, you really need functioning capital markets. And if you want to develop pension, a better social safety net for consumers, you also need capital markets for that. If you need a place for people to direct their savings because property is no longer for speculating, you need domestic capital markets. So there's a lot of reasons why we think that A shares have structural tailwinds behind them in terms of structurally developing the capital markets. That being said, we have a shorter-term trading model, which we rolled out about maybe, I'm guessing, about 5-6 months ago now. So far, the early results of that live are encouraging. We basically have looked at a number of factors that tend to lead to shorter-term outperformance between offshore or onshore. And when we've just recently recalibrated that, it's slightly tilting towards the offshore to the tune of an expected outperformance of 3% over the next month or so. So that's the reason for that sort of tactical preference for offshore, but strategic preference for longer term for onshore.
Yeah, Tim, the way I think that model you've laid out is constructed, things that we'll probably need to have more frequent conversations with you, or either Kinder, and that seems to be giving different signals depending on when we ask it. Back to the rate conversation, it now seems that rates are going to come down, to your point, maybe not as badly in terms of the growth outlook. Are you seeing any clues on what earnings will probably look like next year if indeed we are headed towards some slowdown but not as bad?
Sure. So our numbers are 12% EPS growth for the region for next year. That's a touch below consensus, which currently stands at 14%. I think those numbers broadly, they make sense. I mean, obviously, they're not going to be picture perfect, but the broader thrust of things is that this year is a recovery year from a suppressed year last year, really driven by the semiconductor sector and by the markets of Korea and Taiwan. So you're having this sort of outsized recovery this year. Korea earnings will grow, for example, about 90% this year, and Taiwan's about 25%. Obviously, those rates of growth are not sustainable because they're coming off a low base. So when you get a more normalized year next year, we think about 12% seems reasonable. You can still have some further carry through in places like Korea and Taiwan. You've got some decent growth in India, of course, still kicking in around 15%. You've got somewhat less in some other markets, which are kind of more normalized and where growth is not quite as strong. But overall, if we're looking for nominal GDP growth next year for the region to be kind of high single digit, seeing about 12% EPS growth is perfectly reasonable given the selection bias for companies that are listed in the main indices and a few other factors which we don't have time to go into. So I think that's a reasonable case. Underneath the region, underneath the sort of the surface, then I think you want to understand which parts of the markets will either benefit or maybe less favored by a decline in interest rates. Typically, banks don't do as well when rates are falling, but other so-called longer duration parts of the market, particularly tech and maybe some of the biotech, might do somewhat better when you get a little bit lower interest rates, and that gives you a bit of an uplift in valuation and might help some of the fundamental performance as well.
Tim, always great to have you. Let's catch up soon. Tim Mo, their Chief Asia Pacific Regional Equity Strategist, joining us out of Goldman Sachs. Coming up, a Thai political dynasty set to continue with the daughter of former leader Thaksin Shinawatra looking set to become the next prime minister. We look at the challenges facing Paetongtarn Shinawatra next. This is Bloomberg.
Okay, let's get you the latest in this evolving political story in Thailand. The former Thai leader Thaksin Shinawatra's daughter looks set to become the country's next prime minister. 37-year-old Paetongtarn Shinawatra will contest a vote in parliament today. We're joined, of course, out of Bangkok by Picha Tanakas and Pipats with the latest here. Certainly the coalition did back the daughter for prime minister. Will there be any surprises, though, is my question, in today's vote?
Yes, David, from the way it looks now, the coalition led now by the Pheu Thai party remains intact, and it looks like the coalition will all fall in line when the House of Representatives meet momentarily to vote on Thailand's new prime minister. The coalition party leaders yesterday reaffirmed their commitment to back Paetongtarn's nomination, and they all agreed that Thailand should have a new government as soon as possible. So when we're talking about the numbers, the coalition now has more than 300 lawmakers in the lower house, which is well more than the number that Paetongtarn needs, which is 247 to secure the premiership. So if all the coalition parties fall in line today and stick to their pledges, then there should be no surprises, and Paetongtarn Shinawatra should emerge Thailand's new prime minister, and it's also its youngest and second female leader since her aunt Yingluck Shinawatra from more than a decade ago.
What does this mean for policy? Should we expect continuity from what we had from the Sritha administration?
Definitely, Yvonne. If Pheu Thai retains the premiership as planned, then there should be broad policy continuity. And that means that Paetongtarn's new government should be focusing primarily on boosting economic growth, as well as tackling household debt and high cost of living. Right now, there are also concerns that the change of leadership, though, would provide a convenient pretext for the new Pheu Thai government to drop the $14 billion digital wallet cash handout scheme, which was really struggling to materialize under the previous administration of Sethar Thavisin. Paetongtarn herself was asked about this yesterday, and she herself gave no definitive answers. She said she will look at the program and review it only after she takes power. So that still remains to be seen.
And Pat Picha, should we or can we expect the former Prime Minister Thaksin to play a bigger role in Thai politics from here on?
That's a great question, David, because it's really undeniable that Paetongtarn is her father's daughter, and the shadow of someone who is as influential to Thai politics as former Prime Minister Thaksin would really be hard, if not entirely impossible for her in particular to shake. She herself said that she was consulting with her family about her nomination yesterday, and she received a blessing from her father Thaksin, who was ready to advise her on anything she needs. So we can probably expect Thaksin to play a more visible or even more assertive role in Thai politics from now on, especially if his daughter becomes the third Shinawatra family member to be a Thai prime minister. Especially at a time when she is seen as largely inexperienced. But all this also could lead to, could expose Paetongtarn to accusations that she's only her father's proxy, and would potentially raise even more questions than under the Sethar administration about who really runs the Thai government.
Papicha, thank you, Papicha Tanaka and Pipa there joining us out of our Bangkok bureau. Let's switch gears and focus on Southeast Asia, but talk a little bit more about Indonesia now. I mean, they're getting a new capital city. They're moving its administrative headquarters to Nusantara from Jakarta, and that inauguration is scheduled for Saturday. And ahead of that, we had Mario Hong taking a look at the new city's progress.
Carved out of the jungles of Borneo, Indonesia's future capital, Nusantara. It's located around 1,200 kilometers from the current capital, Jakarta. An ambitious project spearheaded by Indonesian President Joko Widodo. It's funded by a mix of government and private spending. Construction for the massive project began in 2022 at an estimated cost of $35 billion, with reports of massive cost overruns. The aim? To build a futuristic green city in place of overcrowded Jakarta, a capital that's rapidly sinking into the sea. About 40% of Jakarta sits below sea level, and its coastal areas are under constant threat of flooding. This causes about $6 million of losses each year. Productivity losses from traffic gridlock are estimated at $7 billion a year. Though it's being inaugurated this month, Nusantara is not scheduled for completion until 2045. Satellite images in the past few years show the development of the area. But on the ground, missed deadlines and sudden resignations of top officials plague the project. During a recent trip to Nusantara, Jokowi stressed that building a new capital is not a job that takes 1 or 2 years.
We came here to check the latest progress of the Ibu Kota Nusantara, especially the construction of the palace. I see everything is still in process.
President-elect Prabowo Subianto has pledged to continue development of the city. Yet his manifesto makes clear he'll focus on his own policies, casting some doubt on Jokowi's legacy project, even as he prepares for his final State of the Nation. Avril Hong, Bloomberg News, Singapore.
In fact, just on that note that Avril ended that feature with, the Indonesian president, we're looking at live pictures there, will be making his final State of the Nation address in the next hour, and Jokowi will also lay out the budget plans for the country later on Friday that may test some of these big-ticket policy programs of his successor, Prabowo Subianto, who will be taking office, of course, in about 2 months from now. We'll bring you all the top lines from those events as they happen. We also have a trader's guide to the Indonesian budget. Check that out on the terminal and also on the website. This is Bloomberg. Okay, we're looking at a rally across the region here. We are poised to snap out of successive weeks of losses. Japan is doing tremendously well today. Some of these other markets geared towards tech and AI, like Korea, as you can see on your screens, has now also erased all the losses since that manic Monday 2 Mondays back. SK Hynix leading the chip space, as you can see on your screens. TSMC is also doing quite well over in Taiwan. Now, speaking of tech, we're also looking at some earnings reaction. This week it's been busy. You had Tencent midweek, JD.com and Alibaba reporting. Li-Ning reported this morning. Lenovo was also out as well. We have a few other names coming out today as far as earnings go. I think ZTE is coming out today. All that said, JD.com is seeing substantial gains today. 9%, 6% pop in ADRs overnight. JD Logistics is also up 15% or so. And surprisingly, Alibaba shrugging off the price indigestion overnight to the earnings. So we're doing quite well as far as that's concerned.
Yeah, because it wasn't all bad, right? Yes, it did show that, they're feeling the pinch of this sort of weakness in the consumer. But then again, cloud, the intelligence arm was still picking up in terms of some of the demand for AI-related computing workloads. And also, there seems to be, when it comes to e-commerce side, Tmall GMV was rising by high single digits, which I think was still better than some had expected. So there you go. But overall, markets are doing pretty well here when it comes to this risk rally. We're continuing on to see those gains here this morning across equity markets. Commodities are a bit up here as well. And we're watching, of course, those tech plays. Alibaba up 3.5%. Happy weekend.